Stocks ended the shortened holiday week mixed. How will the Fed react to the latest jobs report? Gold is nearing a record high. We've got some stocks poised to rise more than the commodity itself. And there's good news for those purchasing a brand new car, but the same cannot be said for used cars. We'll explain why. On the Barron's Roundtable, my colleagues Andrew Bary, Carleton English, and Jack Hough. So, Carleton, stocks are sending one message, bonds are sending another. I usually say, I think conventional wisdom is the bond market is smarter. What do you say?
Yeah, you got to go with the conventional wisdom here. The old saying is don't fight the Fed. The bond market isn't doing it. The bond market is saying, we're probably looking to some sort of slowdown in the back half of the year, possibly a recession. That's what most people are calling for. The stock market, ever optimistic as it has been. Yes, we had a shortened trading week, some mixed results, but the stock market trading at about 18 times earnings is saying, we're just going to look past that recession that might happen. We feel good about it, and I think you got to lean on the side of caution right now.
Yeah, because at the same prices, if we had a recession, earnings drop, that 18 goes up into the 20s. So what is an investor to do? Yeah,
I think you really just need to look for safety. So assuming that we hit some sort of downturn, the sectors you're going to be looking at, the basics, your utilities, healthcare, consumer staples, things that aren't going to see a drastic drop in demand in a slowdown. The other way to play this, though, is to look at companies that are able to grow their dividends. It's not just about looking for a dividend yield. Maintaining a high yield isn't the game. It's a company that's looking at the horizon and saying, with everything going on, we can actually afford to pay our shareholders more. So some companies that recently have done that, Constellation Brands, you have FedEx and TJX, the parent of TJ Maxx.
Classic defensive plays right there. What are you looking to this coming week to get some more indication of where things are going?
Well, you know me, I'm looking at banks. So we're going to see bank earnings kick off at the end of next week. I think a lot of the bad news is probably priced in. It's still going to be a choppy season because rather than focusing on profitability of banks, a lot more attention is going to be on the balance sheets. Wall Street is not used to looking at that. The results are going
obviously.
Yeah, exactly. So the results are going to probably be a little bit messy. It's going to be tough to make sense of it. Also, we will be getting an inflation print middle of the week, too. Looking to see inflation slowing down, but still obviously much too high with the Fed likely having a lot of work ahead of it still.
And we'll be talking more about that later in the show. But for now, Andrew, Carleton made a reference to defensive stocks. You have been taking a close look at the ultimate defensive play,
which is gold. And gold has been stirring this year. It's up about 10% to around $2,000 an ounce. It's been driven lately by lower interest rates, which basically reduce the appeal of bonds, which are an alternative to gold. And I think the view in the markets is the Fed's going to give up the fight against inflation and start cutting rates, which is also good for gold.
But interestingly, you say it's not so much the commodity itself, but there are stocks that might be a better play if you're interested in the gold investment.
Well, I mean, gold has outperformed the stocks, particularly the leaders, which are mining companies, which are Newmont and Goldcorp. So I would consider them. I mean, Newmont and Barrick look reasonably attractive right now, and they have 2 to 3% dividend yields,
which gold does not famously pay a dividend. Real quick, over the long term, gold has not been a great investment. Jeremy Siegel goes back to 1801. It's returned very little. You go back to the peak of inflation in the 80s. Since then, inflation adjusted hasn't done much. Is this more of a trade?
No, I mean, the conventional wisdom is that gold is a bad investment. It yields nothing. It creates nothing. Warren Buffett is a big critic. But there's value to having gold as a hedge. It's a store of value. And the government can't print any more of it. And there's a benefit to that.
Okay. Jack, I want to talk about cars. So I followed the good, smart move. I bought a gently used car. And then somebody T-boned me at an intersection.
Come on.
So I got to get a new one. And you say, no, don't go for the lightly used. Go for a new car.
Well, look, I've been leasing a new car every few years. I think my car might be beating the stock market right now. Hold your applause. It's a mid-market car. It was $40,000. It was a purchase price when I leased it. It's supposed to be worth $26,000 at the end of the lease coming up. I've been looking at comparable prices. They're $7,500 over that. So I'm up 29% on where I should be on this vehicle. So I can get a great deal if I buy it out of the lease. A lot of people are doing that right now, and that is creating this really constrained supply of used vehicles. Edmunds, by the way, on new cars, this past week they published a report they called sub $20,000 vehicles nearly extinct and $25,000 vehicles next in line. The average new car right now, $48,000. I spoke with a car analyst about what this means for the dealer stocks. He says the used car dealers are really really in trouble because they can't get their hands on used vehicles at decent prices. New car, and we're going to hear from CarMax this coming week. New car dealers are in much better shape. There's not a lot of discounting. Inventories are getting better right now. His top picks: Group 1 Automotive, Asbury Automotive, and Penske.
Okay, before we go, if I'm on a lease, obviously I should buy it out. But what about somebody shopping for a car right now?
I think you buy. New car prices are up 21% since I leased mine. It sounds like a lot, but for 14 years before that, they were up a total of 3%. They flatlined for a long time. I think we're making up for a long period of stagnant prices.
Alrighty, thanks for that.